Hello, everyone. Thank you for joining today for Sigma 360's panel discussion on AML in the cryptocurrency space. We're really excited to explore what's happening in the crypto industry, what red flags financial institutions today should pay attention to, and how AI-powered risk screening can help. So before we begin, I want to let you know that we will be recording today's session. So throughout the webinar, if you have any questions at all, please feel free to use the Q&A feature. We're going to address as many questions as possible during the Q&A portion at the end of the session, so don't worry about that. Now, I'd like to introduce today's speaker panel. First off, we have Brett Manwaring, Head of Advisory and Technology Services at Sigma 360. So Brett has previously led a lot of high-stakes regulatory engagements for the Federal Reserve, and at Sigma 360, he specializes in implementing and validating financial crime technologies for a lot of different clients. Also, we have Justin Snyder. He's our Data Products Senior Manager at Sigma 360. He brings a lot of deep expertise in data analytics and governance, including leading USAID's $10 million flagship anti-corruption program. At Sigma 360, he transforms risk data into insights that power the platform. Finally, today, we're really honored to have a special guest speaker who's very well versed in the crypto space, Omer Khan. He's Managing Director at JS Held LLC and is a financial crime compliance professional with deep expertise in crypto investigations and asset recovery as well. He's conducted technology assessments and led AML program transformations for institutions across both fiat and cryptocurrency operations. With that, then let's get started. So firstly, to kick us off today, what kinds of organizations do you three think are exposed to crypto compliance risks? And where are you seeing the biggest compliance blind spots in crypto today?
Oh, Justin, you're on mute. Strike one.
Yep, strike one. All right. Well, good morning, everybody. Good afternoon. Good evening, wherever you are. Bernice, thanks for organizing today's webinar. I'll try to take a first crack at that question. I'm sure Brett and Omer have far more to contribute, but maybe I can lay down a few building blocks for us to take forward in the conversation. I think there is a huge blind spot for traditional financial institutions, especially small and medium-sized banks, that assume that since they don't offer crypto accounts, they don't offer stablecoin accounts, that they've got no exposure to crypto. I think it doesn't take much to kind of scratch beneath that surface and realize that that can't possibly be true. The stats on U.S. kind of scam losses over the last year put those in the billions of dollars. And those scams are not only done in fiat currencies. There is a heavy reliance on crypto to move fiat currency into crypto and then run it through the mill. And that money is very, very difficult to trace and get back. So, I think on that side of things, if you're a traditional bank, traditional financial institution, and you allow customers to offload money into the crypto space, you're automatically exposed to all of the wild things going on in the crypto space. I think there's the other part of it where I would assume that many small and medium banks have not updated their Know Your Customer background checks into, does that customer, if they're a commercial customer, if they're a business, do they accept payment in crypto? Are they operating, for example, a crypto ATM as their main line of business? So, making sure that your customer, know their business, and baking in those crypto checks into things, I think that's going to be really important. And again, I'm assuming that there's a lot of banks who have yet to update their policies and procedures there. I mean, we see as we kind of dig into things on the data side, I'm spending a lot of time looking at law enforcement records, and we see that nexus between traditional fiat accounts being used as on-ramps and off-ramps for crypto, people aggregating bulk cash and making deposits and then transferring that onto the blockchain. Seeing people try to cash checks from scam victims. And, there's a great case in the southern part of the United States where somebody was running a romance scam. They got their victim to send checks, and some banks turned those away. Others cashed them, and within a few days, those funds were then transferred off to the blockchain. So I think there are some transaction monitoring rules that banks need to be thinking about in terms of deposits and then rapid withdrawals to the blockchain. So there's a lot of interesting things going on there. But the idea that, well, we don't need to worry about crypto because we don't offer stablecoin accounts, that's absolutely full of holes.
Justin, I love when I'm speaking to a bank. It doesn't matter what size it is, and I review the risk assessment as part of a process that I'm engaged to do. And I ask about crypto exposure, and I love when they say, "Hey, we don't deal in crypto." And then I go to my Fidelity account later in the day, and I have the ability to invest in crypto. I can off ramp it, I can move it, and the fact of the matter is, and Omer can attest to this for sure, funds are moving at by or through institutions resulting from crypto gains, which is fine. But you need to incorporate those in your coverage assessment to mitigate your risk, even if you don't on paper have a crypto, offering. There's key risks aligned with different blockchains, but there's also keywords to look for within the transaction flow that could be tipping points. Sorry, it's always great when you hear that, though, for conversation.
We don't offer stablecoin, and so therefore we don't have any risk.
Yep.
Yeah.
That definitely is very eye-opening to the current state of how banks are dealing with crypto or not thinking about it yet. I do think that the associated risk with it, Justin, that you mentioned, is something that all institutions really should be actively thinking about. And definitely agree with your point, Brett. It's very interesting to see how certain banks or institutions approach it as well. So thank you so much for giving us a quick background on the current state of crypto risk and how people view it. Now I'm interested to hear, and this question is also open to the floor, from your expertise, what red flags or risk typologies should we be paying attention to in terms of crypto risk?
Sure. So maybe I'll take a first crack again, and Brett and Elmer can tell me I'm wrong. But no, I mean,
Great team here.
I have been seeing a lot more of this kind of cash aggregator business, individuals operating as cash aggregators. There was a great article in Bloomberg a couple of months ago about a guy who got busted doing this out in California, and he was operating at a relatively small scale. He was, depositing $10, $20, $30,000 at a time. There was a pretty high-profile case out of Florida. This guy named Jorge Figuera. He allegedly laundered about $1 billion in crypto. He would take bulk cash payments, no questions asked. He would ask some questions. He would ask whether the money was green, meaning that it was just money, or whether it was white, meaning it was from the narcotics trade. And he would then route those transactions on the blockchain accordingly. That was a really fun case to dig into and to investigate. We're able to, using our graph, kind of reverse engineer a lot of the legal documents and the affidavits that are in the court system, to be able to trace that individual to the companies that are connected to him, and really nail that down, and then cross-reference it and confirm those assumptions using, for example, federal asset seizure notices, and those confirm the kind of reverse engineering that we're doing to be able to really pinpoint which businesses are involved here. And we have some pretty exciting things coming in terms of data offerings, those legal risks and the asset seizure things. So some fun new things ahead for us coming up soon. Brett, Omer, do you want to add
Yeah,
on to that?
I got something, and for Omer and I have worked together for years, so I kind of want to tee him up with this little anecdote. Um, with I always align to risk, right? I do a lot of optimization, a lot of model validations as it relates to financial crime technology. Ultimately, your tools are your mitigating controls to reduce your risk and your risk assessment. Um, so, as part of that, and what I'm not seeing in banks who on paper do not deal in crypto is assessing the risk once crypto is moved off blockchain into fiat. And part of that is knowing what blockchains there are out there and what risks specifically are associated to them. And Omer can speak to this a lot more, but a blockchain like Monero that has privacy constraints on it is more in the spirit of what crypto is designed to do, anonymous nature in the movement of funds. So, it's something as simply as if you don't deal in crypto, incorporate those risks in your coverage assessment, aligning with your TM tools on fiat, and as well as well, if you don't deal in crypto, you won't have a TRM labs or elliptic, but assessing a risk associated with each one of those blockchains. And then, as a mitigating control, uh, optimizing and looking for ways to execute and search for transactions potentially aligned with those blockchains. And there's many different ways to do it. We'll get into it a little bit farther along in the conversation, but curious what Omer thinks about risks associated, particularly with blockchains, specific blockchains, and what he's seeing right now.
Yeah, there's a lot of risk out there with a lot of all your alternative blockchains. You've got your mainstream, your Bitcoin, Ethereum, Solana's now, but then you get into blockchains like Tron, where a lot of bad actors are operating out of Tether, among others. But from a banking point of view, keep in mind the custodial entities, which could be centralized or decentralized exchanges, are really the main areas that you want to concentrate on and understand your various risks. So a bank dealing with a Coinbase or possibly a Binance are possibly, relatively lower risk than dealing with a KuCoin or some other decentralized exchange where they may not aggregate good data, where you may not be able to tell like where the source of funds are coming from or who they're operating with, among other things, when you are indirectly associated to the crypto world, whether or not you carry a crypto presence or not. And then, moving into what we now call like your crypto-based rules, moving away from traditional finance to the crypto finance, we are starting to look at different movements, but these movements have to be very relative to what's going on in the crypto world today, right? You've got your FOMO type behaviors, the fear of missing out behaviors, where you're trying to invest and capitalize on interesting aspects of crypto, where a lot of news and stuff coming around, to you're more stabilizing your assets or your wealth in a crypto platform as well. So anything from fast moving funds to looking at the type of custody that you're interacting with, and then all the different fintechs that are popping up that may not have a very good presence or a profile because they're fairly new and they may not have good governance. You also want to look at from a banking point of view to ensure that you're dealing with good parties, even though they're present entities and they may be geographically placed in a very low risk geography, but they may not have the governance or the profile to help support a less risky approach.
So, hey, Omar, I just thought of something. So, you deal a lot with the exchanges. I've dealt with them in the past as well, worked with them. And it's always fun learning about emerging technologies over the years, emerging monetary instrument movements. But with, rapid growth comes, a couple misses sometimes. And I'm curious what your thoughts on uh around the easy misses from a governance standpoint that crypto exchanges are missing or they have gaps in. And then second part of that, what would be if they have gaps in a KYC governance protocol? What would be the downstream impact to a bank where those funds are ultimately landing? Like
Yeah, a
who
lot
owns
of
the risk?
so that's a great question, right? So just from a fintech point of view, working into the bank, a lot of these fintechs don't necessarily understand, proper sourcing of funds, right? They'll essentially, take the funds from whatever custody or unhosted wallet into their fintech, and then they're, working as a payment platform or finance platform or, even a gaming platform, whatever you want to call it, or casinos, and then that money ultimately ends at the bank. But not understanding your source of funds, how the money actually came into the fintech, not understanding the proximity of bad actors to where that source of funds emanated from, because not a lot of work is done outside of their ecosystem to understand, hey, this wallet that I got funds from into my fintech, I didn't necessarily see the nexus points of they were associated with blacklist markets or bad actors or even sanctioned entities. A lot of that stuff is not done because, and it may be in very close proximity of that fintech, believe it or not. When I say close proximity, what I mean by that is within 5 hops of 5 wallet hops from that entity. So if this fintech now took on tainted funds and this banking institution is now facilitating the on-ramp and off-ramp for that fund, that the risk carries across the full spectrum, right? Because this bank may not have done enough due diligence about the governance of that fintech, and that fintech may not have done enough due diligence around the KYC or even the sourcing of funds or very commonsensical approach of what needs to be done.
Makes sense.
That makes a lot of sense. I guess like it's really about understanding that there's associated risks down the line and how many hops it can go out and really understanding who you're dealing with and where the money is going as well. Yeah, thank you so much, Justin, Brett, and Omer for sharing all your insights on this. So now let's pivot a little bit, maybe into the risk landscape a little bit. Omer, I know you have a lot of deep knowledge of the crypto industry and investigations also related to that. So these days we hear that there's a lot of like newer crypto fintechs popping up and a lot of different organizational structures as well. So what do you say are the possible shortfalls of AML programs in this landscape, and what could the regulatory consequences look like?
Yeah, there's the in the beginning it was like the Wild Wild West. There's a lot of shortfalls, but now we're starting to see it mostly tie up and tighten up. But starting at the top, the governance or accountability gaps, understanding what's going on with these fintechs, where there's like unclear AML ownership between the product or engineering or compliance. They're just building for the case of building up a crypto enterprise and moving the funds as needed. But additionally, we also see compliance functions that lack authority or independence, and they're being run by the business units and not necessarily from the compliance interaction that it should be. So clearly, I'm sure everybody on the phone knows that enforcement actions against these can be pretty extreme. The other thing that we start to see more of now is with the use of more sophisticated technologies, whether it be AI, machine learning, or even your traditional engineered rules on how we look for bad behaviors. There's still a big misalignment between models and AML design and overall business model, especially when we see cross-chain activity, because today obviously nobody stays on the one chain. We have concept of wrap collateralized assets, or we have movement from one asset to another, like Ethereum to Solana or Bitcoin to Ethereum, among others. Wallet to wallet transactions, which we see are a big miss. Like I was saying before, within a certain proximity, you can see very easily that there may be bad actor relationships or just obfuscating of funds, where I may have a wallet that may have hit for a red flag. It's very easy for me to create a new wallet, move funds, and then start interacting like I'm a very clean party. Another thing that I think is very commonly overlooked are nested or offshore VASPs or other relationships. So you'll find within even Binance or Coinbase and others, you have entities working out as nested operators from these this bigger entities, and the visibility to the customer's customer is often limited. Then moving into a little bit more into the weeds, you start looking at over reliance on incomplete transactions. That's a big miss today. Monitoring that works only at onboarding, but not in the total life cycle. You have your KYT rules, your know your transaction rules that flag, but they may not be operationally reviewed effectively. And then the manual monitoring is often unsuited for the crypto velocity movement. This is where we see a lot of big takes because of either FOMO or just general activity that we don't necessarily get to chase on the manual intervention. But I would say those are my top tier misses and gaps.
Got it. That's definitely a lot of great points to keep in mind, especially for our audience, who I'm sure is anxious to know how to improve AML programs and how to make sure things are robust. So just thinking along the lines of that, then, how would you say effective due diligence tooling, say, can help with the investigation process into just crypto risks in general?
It's certainly effective, but like I said, it's a life cycle approach. Not just concentrating on the initial onboarding, but ensuring that due diligence tool is often involved throughout the life cycle, understanding the transaction volumes, patterns, but then associating attribution. Crypto world is still to some state anonymous, and they like to keep their anonymity. So it's hard to find attribution for certain wallets that they may be interacting with, and not even understanding the true risk of what that unattributed wallet may carry. But understanding the frequency, the dynamics of that wallet, how often they interact with it, or what type of coins they interact with it, are very critical measures that we take. And then there's overall clustering activity. So to look at, how often is the banking institution involved in the on-ramp, off-ramp versus a much more diversified on-ramp, off-ramp solutions, which some do carry. Because it's not, I no longer just bank with my bank. I can bank with a PayPal, or I can bank with others as well. So it's not necessary I can just drop in all my funds here. So understanding that diversity, understanding the patterns of behavior, the proximity, and then using those due diligence tools to help fill the gaps, understand the attributions, even look at seasonal patterns or behaviors, and then any other augmented intelligence that these due diligence can provide to help solution, like, hey, there may be, like in the cyber world, we know when a cyber attack happens, so we constantly look at certain segments more closely because they may be attracted. So we would kind of see that in traditional finance as well. And we've created a lot of different types of algorithms, not just in AI or machine learning, but also very engineer algorithms that can be very easily distributed to kind of capture these behaviors and look at the life cycle in completeness.
Definitely a lot of good things to keep top of mind there. Before we move on to the next topic, Justin, Brett, anything you wanted to add to this?
I got a more of a SME question for Omer, and I'm always interested in this. And Justin, this kind of delves into your world too, with data and getting data on OSINT to incorporate into our tooling. Omer, like when you're performing an asset recovery exercise or an asset tracing exercise on the blockchain, obviously you're embedded in the blockchain, you're looking at the flow of funds, you're looking at a little bit of a history with regards to that particular wallet. How do you incorporate off-chain due diligence into those investigations? Do you look at, if you have a name aligned with the wallet because where their account resides at a crypto exchange, do you use that breadcrumb to I guess expand out your investigation to incorporate more parties? And a little open-ended, but
no, it's a fair question. In crypto, it's we cast as wide of a net as possible to capture our entities and all the various intelligence. We even go as far as not just attributing through general sources like your conventional blockchain tools, but we also scrape our own data from social media, the dark web, believe it or not, even like repositories like GitHub, which I'm not sure if everybody's familiar, but GitHub is a repository for programming needs where we can store our code and everything else. So we're literally looking for wallets, mentions, names, among everything to scan and build a very holistic and complete profile to capture what we can. Then we start looking at news events, whether it be negative or positive or in the middle, to see how they've impacted anything. So, like I said, in crypto world, there can be a lot of FOMO or there can be a lot of other influence-based, transactions. So we understand that in context and then develop a strategy around how we need to chase from whether an asset recovery, investigations, or a simple investigation when we're in our compliance, we have compliance hats on. But we are looking at everything, open corps to whatever. And this is where I think Sigma is very good, where you've aggregated many sources into one profile that we can attack at once versus me having to go out and hit so many different resources, like an open corp or OFAC list or negative news or whatever. So Sigma, helps in that front quite a bit for us.
Thanks,
Awesome.
Justin.
Yeah, so I mean, like Omer, as I alluded to earlier, I think that tool, our platform, is going to get even better in the coming months, where we're getting ready to be able to serve up court records, parties who have been involved in cases, being able to serve up asset seizure data, and as you know, doing these kinds of investigations, those can be incredibly rich and deep sources, where you're seeing that direct on-chain to off-chain identity linkage being formed and being proven out in court. And so, that's a tremendously rich resource that we hope to put in the hands of more and more investigators coming very soon.
Yeah.
That's why I said thank you, Justin. I knew it was coming. Can't wait.
I think everyone on our team will echo that sentiment for sure. But yeah, that's thank you, Omer, for giving such a deep dive into crypto and investigations. So now that we've mentioned Sigma and other solutions, let's talk a little bit more about practical implementation strategies, as I'm sure a lot of us really want to leave this webinar knowing what to do next about the crypto risk. So maybe Brett, with your knowledge as an advisory expert, what in your knowledge should teams get started with when they're implementing AML in their compliance workflows?
That's a rich topic, and I think we overcomplicate it sometimes when we're aligning with the core requirements of an AML program. If you're a crypto exchange, and we've seen great documentation, we've seen bad documentation, but you'll see that at regular institutions as well, regular banks. But start with the basics. So align with the spirit of the reg. So KYC, onboarding, EDD, get the proper documentation, evidence who that person is, ask the questions that nobody likes to ask. Source of funds, source of wealth. Look, during your EDD process or your ongoing due diligence process as it relates to the client, and institutions do this, but really look at the transaction activity and ask the questions as part of the RFI, because we've seen it. It's very easy, and I hate to stereotype, to identify a young person with a incredible amount of funds in, funds out. Then you go to his or her social media handle and you're like, this guy, he's doing something right in crypto. But it's not listed on his source of funds, source of wealth. Sometimes by design, sometimes, people just aren't straightforward when they're filling in that documentation. But you have to arm your team, your compliance team, not only with the tooling to investigate, but the training to identify potential crypto activity. Now, this goes back. I've been in this for a long time, and going back to 2004 when the KYC reg was being formulated and really enacted at institutions resulting from the Patriot Act. Nobody wanted to ask those questions: source of funds, source of wealth. We used to have exercises with private wealth managers, how they can incorporate these questions naturally into discussion if it was unknown. But there's ways to identify crypto activity. And the reason why it's so important, and what I used to tell people back then, a high risk client is not bad. It just means you have to watch them differently. And we have to identify who those high risk clients are. And what's the downstream impact of that? Again, education, training, incorporating crypto centric focus into your risk assessment, into your ongoing due diligence, into your investigations. Because even if you are on paper not impacted by crypto, or you don't deal with crypto, you don't offer a stable coin at your institution, you are dealing with crypto. But it's important you know the risks. There are unique jurisdictional risks associated to crypto users in certain jurisdictions. There are unique payment processors that are aligned directly with bad crypto exchanges. Educate yourself. Make that part of your coverage assessment process. List the blockchains that are more at risk, and then to identify mitigating control. Develop strategies with your data analytics team in house, with a advisor, with someone to represent that you're mitigating these risks not only on paper but pragmatically through your core AML processes like KYC, AML, or KYC, EDD, transaction monitoring. Look for ways to identify crypto transactions that are off-chain, especially ones with bad or more risky crypto exchanges. It could be a keyword. It could be a payment processor that moves the funds on the fiat side that is partnered with a crypto exchange. But nonetheless, you have to know what to look for. And then lastly, you need the appropriate financial crime technology to do that. It's one thing to have know you have crypto exposure, to have one of the toolings out there that is on blockchain, like TRM Labs, like Elliptic, Chainalysis. They're all great tools. They have great wealths of wallet listings, but it's also, you got to arm yourself with the information to identify those who are receiving funds once they are off chain. Who are these parties? Who are their associations? Especially if they are high risk, especially if they do not divulge, they deal with crypto as source of funds, source of wealth. And how do you do that? You have to see their associations. You have to see if there's adverse media aligned with it. And then, Omer, thanks for the shout out to Sigma. But you need a tool like Sigma that is centralized, all in one spot, that will give you a relationship graph in the event you do find something out of the ordinary. If you see something we used to laugh about it, Tron, I used to think it was a joke, the name of that blockchain back in the day when it started emerging. But, Omer said it's one of the favorites for nefarious activity. If you see an indicator associated to Tron in a wire string, or a payment processor associated to Tron in a wire string, that's a tipping point to obviously, update your KYC information, but potentially investigate. And, in those situations, we have a lot of misses because we don't have that coverage. And I say we because I'm in the industry. A bank does not mitigate the risk associated to crypto, especially if they have a large footprint jurisdictionally, because they say they don't deal in crypto. It's really mainstream. It's part of our world. Everybody's thinking about it, not necessarily into it, but thinking about it as an alternative investment strategy, as you should. Any other thoughts, Justin or Omer, on that? How we can get better with data, how we can mitigate risk a little bit better?
Well, I would just kind of go back to that point about the industrialized scam industry that I started with, right? So it's not just about banks protecting themselves from being involved in, for example, narcotics, supporting the, facilitating narcotics trade or facilitating payment to terrorist organizations. Those are clear, very clear concerns. But there's also the current concern and the value that banks can add to helping to protect their customers, right? Looking at who your customers are, if you have a large portion of your customer base that is, say, over 60, and they have never done a transaction involving crypto, and then all of a sudden they want to send $20,000 to a blockchain, like, you need to, as a bank, be looking into that and asking questions. And if you can, hold that payment to figure out why out of, all of this time are you now getting into, are you making an investment? Are you sure about that investment? Has somebody contacted you for this payment? I think banks have a huge role to play in helping to safeguard, American consumers and the American public from what are often, overseas orchestrated scams. We saw over the last several months the work to take down industrial scam compounds in Cambodia. That's great. It's positive news, but that has been kind of proven out as a proof of concept, and it will find a new home, and that threat will continue. So for banks to be able to update their rules to help keep their customers and their money safe, they have a huge role to play.
Okay.
Yeah, the one thing I'll add to that is just to Brett's point. I know everybody here has probably worked on every single financial crime solution on the planet, but we all know how rigid they are. Brett and I even went out and built our own system for certain engagements because we find so much rigidity in these compliance solutions. They don't cover everything at once, and you have to start getting very creative about what you can do downstream once an alert is processed. And we start looking at everything from strategic routing, which basically means routing the more complex alerts or even simple alerts to certain parties where they're going to make effective decisions, they're going to be qualitative, and they're going to be fast, not to create bottlenecks when you do get overwhelming alerts. Two, you want to start synthesizing the data better so you can understand where your obvious false positives are. I hate using the word bulk closure or auto closure, but there are clear needs for that where that you can kind of lessen the burden and clear out the white noise if any exists, and really concentrate on the more complex alerts where you do need that attention and traffic. But understanding that, and then obviously creating a very healthy knowledge base, not just of patterns of behavior, but also looking at the data elements that influence it all, so you can take that knowledge base and retune or optimize your existing algorithms, whether they be engineered algorithms, machine learning algorithms, or AI algorithms, to help tune and effectively learn and build a knowledge base that actually can teach that, versus having to concentrate on expertise that in this industry, unfortunately, we often lose to attrition. And these are all just areas of opportunity that we can all help on if needed. But you really have to look at this very holistically versus being very dependent on the solutions that are in place that act as your compliance, first line of defense.
Thank you, everyone. This is all amazing advice for institutions who want to be aware of how to combat crypto and associated risks as well. So last question then, just to wrap up the webinar. For the risk leaders on this webinar who really just want to take action after today, what do you think that they should be looking for in a technology partner? For example, I remember, Brett, you mentioned like having the appropriate fin crime technology. Say, how do we at Sigma 360 plan to support crypto partners in the future then? Maybe that's a question for you, Justin.
Justin, go ahead.
Well, sure. So, a lot of what I see is and get asked about is, do we have the data that can help, right? So, are we able to pick up on kind of broad KYC, KYB data, but also then clear risk signal? I think having the best possible data puts us in a far better position when it gets to the AI agent tools that we have built and are running now to help weed out clear, clear yeses, clear nos, and let human review teams focus on the gray zone in the middle. And our tooling has been set up such that that's all adjustable according to an institution's risk policy, both for news and for the structured data that we're bringing in. I think Omer was getting to that point about having a technology that really addresses your pain points, allows you to focus on highest risk areas that really need a human review. We hear it a lot in terms of clients that we're working with. I don't need more alerts, right? I need better alerts. I need alerts that are really actually something where a human has to roll up their sleeves and put some time into looking into it. And I think we're building a solution that definitely helps bring down, false positives and issues on matching errors. But also we have the functionality with the AI-driven L1 agent and AI-driven news agent to help human teams do more. And I think we're helping financial institutions really tackle some of the pain points they've experienced with those traditional kind of rigid tools. Brett, do you have anything you'd like to add to that?
Yeah, my only thing to add, and apologies if I repeated from repeating myself, but I can't stress it enough. If you are a traditional bank, align with your risk. Know your risks, more importantly, so you can mitigate them. Know your exposure. But then, for one of the things I mentioned, keywords, associations to nefarious blockchains or historically nefarious blockchains or payment processors aligned with them. Respect the process when trying to mitigate that risk. It's not just simply adding a keyword as a mitigating control. It's going through the process from a governance standpoint, testing, seeing if it works in a UAT environment, reviewing that output, and then lastly, just justifying your decision on paper. So a third party, a regulator, in-house auditor can understand your rationale. It has to make sense. But we have to use our risk assessment as a tool to guide us. But we also can't simply say we don't deal in crypto because we don't have a stable coin offering at our institution. Because you do, and I've seen it many, many times. And if you do deal in crypto, if you do receive money in any form or fashion these days, you are dealing in crypto, so you got to mitigate that risk. And then lastly, the tooling to help investigators come to a decision point to make that investigative leap and determine if that person is potentially SAR worthy, if that person should be debanked. And something Justin mentioned earlier, but being an AML person, I'm not really fraud focused a lot. You have to protect your customer base. There is elder fraud it's just rampant these days. And if somebody's requesting 20,000 Bitcoin or $20,000 worth of Bitcoin or any cryptocurrency for that matter, and they've never done it before, it's probably worth looking at. And if you can identify that in a flow, a wire flow or a ACH flow somehow, some way, it's worth looking at. So it impacts fraud to protect people, but it also protects, obviously, the reputational risk of the bank. Yeah, that's it. Just be proactive.
Yeah,
That's
I would just say it was
amazing.
three things that I think any technology to look at.
Mhm.
Justin covered the data integration component of it, but in data integration, just the augmentation enrichment of that data. If you have data, but it's not, oftentimes we plug in data, but it's not complete. So, making sure the name's full, the date formats are complete, the metadata is there, among other things. The secondary point, I think it has to complement your process at the bank. So it cannot be a disruptive tool that you have to have a big learning curve and try to understand how to move funds, move alerts or clear alerts or even log alerts appropriately. And oftentimes what we see is people work outside their compliance systems in Word and Excel and everything else, and then bring that intelligence in partly to justify those decisions. And finally, the third point, which I think is the most critical, is a good reporting scheme. Oftentimes we see very simplistic dashboards that don't do anything but just how much are we having in open close or presenting bottlenecks. We need to be a lot more clear about our key data elements and our critical data elements that help drive decisions, not just for compliance teams, but also for our executive teams that turn back and say, okay, no, we need to tune this more effectively because we're getting a burden of unnecessary false positives, or we're not getting enough in this aspect of an investigation, or even just error monitoring, where some of your compliance units analysts may be having too many revisions on certain alerts. So we look for these opportunities to help make a very effective compliance team and overall platform.
Awesome. Thank you, Omer, Justin, and Brett, for sharing so much on your expertise and on how best to implement AML technology. So really, it's, I guess, just to sum it up, about data, having robust data, tooling and technology as well, and then also making sure to continuously test and review, and also justify decisions to regulators. And as Omer said as well, a reporting scheme is important too in that. So yeah, just to wrap up, we've had some great questions come in from the audience actually, so let's dive into those now. The first question is, if you could give compliance leaders one piece of advice about crypto risk, what would it be? And this is open to the floor as well, so feel free to take it, anyone.
I'll jump in. Just know the risk. Educate yourself. And again, I'm calling back to, the core components of an AML program. This is training. Educate yourself, educate your team, know what to look for, because ultimately it will impact other verticals of your AML program. KYC, EDD, transaction monitoring review. And then lastly, make sure your risk is captured in governance. But you have to know what to look for to do that.
Yeah,
Great.
there's a lot of tools out there, open source tools that you can look at that you don't necessarily have to subscribe for, like a TRM or a Chainalysis. I can recommend Arkham or Breadcrumbs, among others, that can give you a lot of good intelligence on dealing with certain wallets or proximities, or just in general, like, how healthy a certain wallet or transaction may be to your institution. But again, it's all a commonsensical approach. A lot of your traditional finance risk and exposures do apply, but it's just at a higher volume and probably a higher value in some cases as well. So just keep a very commonsensical approach towards it.
Awesome. And there's another question that came in that is, where should organizations start if they suspect that they have indirect exposure to crypto? So maybe just like first steps organizations can take, really.
Well, it depends, what your exposure is. If you have a tipping point where it's very urgent, I would remediate. I would identify first what your exposure is that you know of and expand it out. When you expand out, you can focus in on that direct exposure that you do have, or direct, if you will, exposure that you do have. Look at your activity over a period of time to see if it repeats, but also expand out to other potential risk categories within crypto. And again, we're limited a bit to the data architecture we have, especially on the fiat side. What is a potential crypto tipping point within those flow of funds within that information? But it is still a wealth of information. It's not nothing, and you can delve a lot from it.
Yeah, just assume that you have exposure. and just maybe go collect the keyword list of crypto related entities, whether it be exchange names or crypto terminology or whatever it may be. You clearly have indirect or direct exposure with an exchange or a DeFi or even a Fintech platform that deals in crypto. Take that keyword analysis, start adding on dates, frequency, value to that, and see what kind of exposure to hit, and see if any of those transactions have ever been caught in your compliance solutions, to then expand from there and build up your strategy from there.
Omer mentioned it earlier, develop analytics and reporting to align with this, because there are trends with it. Those trends will tell you if it's FOMO, it will tell you if it's market driven. And if there's anomalies within those trends, it's probably worth looking at, because it is out of the ordinary. So got to arm ourselves.
That's definitely something to keep in mind. We have one last question. So, what are the current methods for marking high-risk data or addresses, and what factors are used? Maybe this is one that you can weigh in, Justin, or anyone else too.
Sure. Well, I can give a very quick answer. Omer can probably give a lot more color to it. The things that I'm focused on are really when they get to that level of direct enforcement, right? Is a wallet showing up in a court case? Is it being seized by federal law enforcement authorities? Are we seeing not only the wallet, but the exchange that was used, as well as the individual, the user ID, those kinds of things? We're able to flag those straight away with a law enforcement action kind of risk flag. But when we're talking about kind of below that threshold, before they've been arrested or the funds have been seized, Omer has done a lot more work in that space in terms of being able to intuit certain levels of risk.
Yeah, I appreciate that. So I think the very simplistic view is looking at the life cycle of the wallet, first transaction, last transaction. If it doesn't have a very big footprint, it's clearly a new wallet, and certainly treated as high risk. Where well-established wallets that have a lot more historical presence, and you can see this on the public blockchains. It's nothing that you need a very proprietary tool for. You can go either on the block explorer for the particular wallet that it resides on, or you can look at tools like Arkham Intelligence, which is open source, or Breadcrumbs, which is another free open source. And then from there, look at the value, look at the frequency, look at the interrelated wallets within. I just stick to 1 to 5 hops from that wallet to understand where the source of funds are coming in from, or who this wallet is feeding to, and then also look at the main exchanges or source of funds that it controls with. So if you see a Coinbase on there or Binance on there, it's relatively medium to low risk. But if you see another exchange which is unregulated or probably sanctioned, like a Garantex or something else, then obviously you want to up the risk immediately and keep a close eye on it, or de-risk it off your platform completely.
Awesome. Well, I'm afraid that I think that that's all the time we have for questions, but anyhow, thank you so much for sharing your insights, Justin, Brett, and Omer, and we're just going to wrap up here. Thank you for your time today and for your attendance. We're going to be sharing the webinar recording to you after the session, so please do keep an eye out for it in your email. If you have any questions to us, please feel free to reach out to the team, and we look forward to connecting with you in the future. Thank you.
Thanks, everybody.
Thanks so
Thanks,
much.
Bernice.
Thanks,
Thanks, Omer.
everyone.
Thanks, Justin.
Yeah.
Thank you.